Please help me welcome Daniel Culbertson, Senior Economist of Indeed Hiring Lab, to the stage.
Thank you for that introduction. Hello, everybody. It's good to be here with you all today. Yes, my name is Daniel Culbertson. I'm a senior economist with Indeed. Here at Indeed, I work on what we call the Hiring Lab, and that's the global research team that we have on staff to dig through all of Indeed's data, the job search, the job posting, some of the resume information that we have. To a group of economists is essentially just a giant pile of labor market data. We use that to see what insights we can tease out about the labor market. All of the research that we do lives on our blog at hiringlab.org, which is a free resource for anyone interested in labor market insights that houses all of our research. Some of the trends that I'm going to show you today are actually pulled directly from that site. So we have an interactive tool where you can go in and plug in different states, different cities, different job categories, and see what those job posting trends look like. So I encourage you all to check that out. Again, hiringlab.org is a free resource of information available for you all. But what I want to do today is give an overview of the labor market. So I'm sure you're all going to have a lot of discussions today that are very recruiting focused, very RPO focused, though this is taking a step back to take a look at the overall labor market, see what trends we see at Indeed on the public data, get a sense of where things, I'll talk a little bit about where things may be headed, but I think a lot of this will be providing data to some things that you're already experiencing, hopefully give you all some big picture things to think about when you're thinking about your recruiting strategies and the labor market that we're currently in. So today I want to cover a few different topics. So I'll talk a little bit about the tight labor market, which we're all very well aware of. You don't need an economist in a cheap blazer to come to your conference and tell you about the tight labor market, but I can show you some of the data behind that. And that'll bring us to the strong labor market and what we see on the demand side. I'll also talk about high wage growth, particularly with what we're seeing with job changers. So Ben already talked about ghosting and a lot of the churn that we're seeing in the labor market, so we have some data related to that. Talk a little bit about what we're seeing on the labor supply side. That's where we still have a lot of our issues in the labor market, and then wrap things up with remote work, and then give you some broad economist advice for recruiting in our current environment. But before I get into those, I do want to talk a little bit about the road ahead. I know that is on a lot of folks' minds. We're always thinking about what's coming down the road 6 months to a year from now. These are very precarious times. We've heard a lot of talk about recession this year. The reason we're hearing so much of that is the Federal Reserve is raising interest rates with the explicit intention of slowing down the economy. And there's always a chance that they have a very small target they're trying to hit where they can dial back the economy a little bit to get inflation and a lot of other things under control and not send us into a recession. That's a very fine target to hit. The Federal Reserve doesn't always have a great track record of doing that. So there's always a possibility that they could tip us into a recession. There's also been a lot of debate about whether we're in a recession right now. Coming out of the pandemic, a lot of economic data, especially in the labor market, is really just all over the place. It's tough to interpret where we are right now. If you were to ask me, I would say we are probably not in a recession right now. And the reason for that is how strong the labor market is. And so we're still adding about 300,000 to 400,000 jobs on average every month, which is incredibly strong job growth. We still see job openings very high, both on Indeed and in the public data. So there's demand for workers there. Ghosting is still a problem. The quits rate is still high, so workers are still confident. In layoffs, there's been some very public tech announcements from companies cutting back, hiring freezes, layoffs. Those always tend to make news, but when you look across the labor market data, layoffs still remain very flat and very low. And so the labor market is still humming right along. And so that's the main takeaway that I've been reminding employers and anyone else interested in the labor market is that we are in a very job seeker driven labor market right now where demand far exceeds supply. It is very difficult to find talent. That job seekers market is pretty firmly entrenched. It's tough to know what's going to come 6 months to a year down the road. The gentleman up here from TTX, we're talking about their economists, were predicting a short, shallow recession, certainly a possibility. My takeaway is I don't know how much that dynamic of a difficult recruiting environment is really going to change, even if we were to fall into a shorter, smaller recession. That's going to change the labor market a bit, but with demand far exceeding supply and it being such a job seekers market, I don't know how much a recession is really going to change that. So the takeaway for employers is that the strategies that you have today in recruiting in a tight labor market and what you've been doing over the past couple of years to really thrive in this type of market, I think could very possibly still be valid here in the next 6 months to a year, no matter what we see economically. But for right now, we are still very in a tight labor market, and as I mentioned, we've all been experiencing this for the past couple of years. I do want to show you some of the data behind that to give a sense of where we are and how that has or hasn't changed. So when economists want to look at how tight the labor market is, how difficult it is to recruit, we're just looking at supply and demand. And so on this chart here from the Bureau of Labor Statistics, we're using unemployed workers as a measure of supply and demand, job openings as our measure of demand. And we're showing this as a ratio, so we're looking at the number of unemployed workers that are out there for every job opening. Now on the far right side of the chart, you can see this figure is below 1, meaning there are more job openings out there than there are unemployed workers to take those roles. That just gives us a sense of that imbalance in the labor market. And even by recent history, early 2020, pre-pandemic, we were in a very healthy labor market with a very difficult recruiting environment. This figure was also below 1. Job openings outnumbered unemployed workers then as well, but you can see we're much further below that point. The good news is that this line has only moved horizontal in the past couple months, so the labor market is no longer tightening like it was heading into this year. We haven't really gotten any relief, but it's at least no longer getting worse out there. Part of the reason we're in such a difficult recruiting environment and a tight labor market is strong demand. Coming out of the pandemic, demand has probably been doing too well. That's, it's a much larger discussion about inflation and the Federal Reserve, but part of the reason we're in that mess is the demand inside of the labor market came back quite strong. This is something we can see in public data. It's something we see in Indeed's data as well. So starting off with Indeed's data, this is the overall trend for job postings on our site. This is something we never talked about publicly before the pandemic, just for reasons related to our business. But the pandemic gave us a great opportunity to step in, create a labor market indicator that was pretty real time, and get a sense of what was going on. So this is the overall trend for job postings on the Indeed site. As a job postings aggregator, Indeed scrapes jobs from all across the internet. Anything that looks like a job posting winds up on our site. So from the Economist perspective, we think of this as a look at the online labor market at large. This factors out paid advertisers, sponsored jobs, all of that with Indeed. We show this data as the percent change since February 1st, 2020. So on the left side of the chart, that's our pre-pandemic baseline, and you can see how the labor market changed during the pandemic. That incredible run-up in demand is right there on the middle of the chart. We saw job postings on our site climb consistently for the better part of a year and a half. We hit a peak at the end of 2021, and you can see since then job postings have just been moderating, slowly edging down on our site. That's the labor market slowing down a little bit. But as of September 23rd, we're still 48.5% above our pre-pandemic baseline. And so, yes, the labor market's moderating, but there's still just an incredible level of demand. We're still nearly 50% more jobs on our site than we had pre-pandemic. So a lot of demand out there, and for all your employers, that's competition that they're facing when they're looking to make hires. We see this same trend in the BLS data as well, which is always comforting. That lets us know our data is telling us something true about the labor market. This is the job openings trend from the Bureau of Labor Statistics. Very similar trend. A strong run-up in job openings all through 2021. Began to level off heading into this year and has even ticked down a bit. So it's good to see that reflected in our data as well. This is a screenshot from the interactive tool that we have right on our website. If you go to hiringlab.org/data, that's going to give you this interactive tool that I mentioned. You can plug in different countries. We have markets and economists in several markets around the globe. You can plug in different geographies, different job categories as well to see what those job posting trends look like. I know that you all recruit and have clients that recruit for a wide array of different businesses. So I threw up some of the usual suspects here just to get a sense of how these job posting categories look. A lot of that moderation that we see in overall job postings, that extends throughout the labor market. In many different categories, we're seeing job postings slowly trend down. So, for example, software development is the one that really sticks out here. We've seen job postings for that fall pretty drastically over the past couple months. We also have retail and loading and stocking, which is all warehousing. Similar trends, either flat or falling. Healthcare has really been the one exception so far this year, which is typically the case. Healthcare is typically pretty strong demand no matter what's going on in the overall economy. Those are some of the few categories that we see job postings on our site jumping up. One of the other concerns about the labor market right now on the demand side, and this is something that Ben was discussing earlier, but just labor market churn. So when economists talk about this, we're looking at the quits rate as measured by the Bureau of Labor Statistics. This was called the Great Resignation over the past year and a half. We heard a lot about that, especially last year. And this chart lets us know why we heard so much about that. So the quits rate is just the percentage of workers who are voluntarily leaving their job every month. This is the quits rate for the entire labor market. The BLS has measured this for about 20 years. This is most of it. Pre-pandemic in 2020, that quits rate that we had, that was the highest it had ever been at that point. And that was because this tends to move in line with the overall economy. When things are doing well, quits rate rises because people are aware there's other opportunities out there. They go out and find those jobs. When things hit the fan with the economy, people tend to hold on to the job that they have, so you see that quits rate decline. So pre-pandemic, we had the highest quits rate we had ever had before. We were in a very healthy labor market. It fell during the pandemic, and then you can see how that just rose after the pandemic to a point, our new high level that we've ever had for the quits rate. So, and it really hasn't budged much since then. It's come down a bit, but we're still experiencing some of the most churn we've ever seen in our labor market. And so everything that's associated with that, with people switching jobs more often, people more likely to ghost, everything that's associated with that is still a factor. And this isn't something that we're going to get much relief from until we see the economic climate change a little bit. So we'll have to stay tuned for that. One of the upshots of a very tight labor market is strong wage growth. And this is something that we've seen across the board. Employers raising wages to stay competitive. There's been some industries that we'll see where it's been particularly a problem and wages have jumped up incredibly high. But by and large, every industry now has much stronger wage growth than it did pre-pandemic, and that's just a function of a tight labor market. But going back to that quits rate, and then going back to the job seeker ghosting problem and everything like that, something that's pretty interesting when you look at the wage data is you can see why people are moving jobs so often. So this is something I pulled from the Atlanta Federal Reserve. They have a wage growth tracker where you can divide up wage growth data in some pretty interesting ways. One of the ways you can do that is comparing people who tend to stay in their jobs and people who switch. And so this is the gap that we're looking at here on this chart. And so the green line is people who switch jobs. That's their wage growth. You can see there's always a bit of a gap that opens up when the economy is doing really well. And that's certainly the case now. On the far right side of the chart, you can see how much that gap between people switching jobs and staying in their jobs has opened up. And so there's likely a lot of factors that play into someone's decision to switch jobs, but we can see right here in the wage growth data that people who switch jobs are getting significantly higher wages, so pay is often something that is factoring into that decision. When we look across the rest of the labor market, strong wage growth across the board, but as I mentioned, there's one or two winners here. Transportation and warehousing and leisure and hospitality have been the two categories that are most difficult to hire in. They've seen the strongest wage growth. This middle column on this chart, and this is all Bureau of Labor Statistics data, this middle column is year-over-year wage growth, how have wages changed over the past year. That third column is the 3-month annualized, so more recent, over how have wages changed over the past 3 months. And so a couple takeaways here. Very strong wage growth across the entire labor market. There's a few categories that are leading, but then also you haven't really seen a lot of these slow down. So for example, something like leisure and hospitality, nearly 12% wage growth over the past year, and then over the past 3 months, it's still around 11%. So we're not seeing a lot of slowdown, and this is tangentially tied to the inflation problem that we have right now, where we haven't seen a lot of change there yet. And this is something that, again, probably won't slow down until the labor market starts to slow down a little bit and stops running so hot. But something that we see employers doing on our site to combat this and stay competitive is being very upfront with what they're willing to offer financially to get people in the door. and in this case, putting signing bonuses right inside of the job description. This is something that wasn't very common pre-pandemic, so we can see here, this is the share of job postings on our site that feature mention of a signing bonus. Was not very common before the pandemic, rose pretty drastically in early 2021 when everyone was trying to hire at the same time, and has leveled off, but this is still several times more common to see a signing bonus right inside of the job posting. And if we look at the job categories where this is most prevalent, this is something that is most common inside of healthcare. So these are the job categories that, with their share of job postings mentioning a signing bonus back in July of 2019 and then compared to July of this year. And you can see this move to the right in all these categories, so it's become more common across. But there are some categories where it's just much more prevalent. Nursing, for example, nearly 1 in 5 of their job postings these days has a signing bonus right inside of the job posting. And something like medical technician, it's about 1 in 10. And so healthcare dominates here, but we also see this in driving as well, where historically there's been a lot of signing bonuses in that industry, still common today. So I mentioned labor supply. That's still where we have a lot of issues in our labor market. Demand, as I mentioned, came back probably perhaps a bit too strong. Supply, the crux of the issue is we just haven't got all of the workers that we lost during the pandemic back into the labor market. We're still about 500,000 workers short of where we were pre-pandemic in our labor force. And then when you think of how much our economy's grown over the past 2 years, you see how that gap opens up. And so we're just not back to where we were before yet. We're getting close. And so this chart is the labor force participation rate for prime age workers, those aged 25 to 54. And you can see we lost a lot of workers at the onset of the pandemic and got a lot of them back pretty quickly. But it's been slow progress getting the rest back. We are nearly back to where we were pre-pandemic, but there's still some gaps out there. One of the biggest gaps that we have is older workers. So older workers left the labor force at a higher rate during the start of the pandemic and have been much slower to come back. And this is important because it remains an open question of how many of those workers are going to come back, since so many of them are very close to retirement age. And so if you're recruiting or you're working with folks who are recruiting inside of skilled trades, a lot of technical roles, manufacturing, transportation, for lack of a better term, a lot of blue-collar roles, those tend to rely on an older workforce, and those tend to get more interest from older job seekers. So this is a current issue for recruiting in that labor market, older workers not coming back quite as strong. Some of the good news that we've had in the labor supply side is that gap that opened up during the pandemic in labor force participation across gender has all but closed and actually reversed. And so what we mean there is with schools and daycare issues during the pandemic, that put working parents, especially working mothers, in a pretty tight spot. And so we saw their labor force participation fall much more drastically, and it was slower to come back. That was the gap here between the yellow and blue lines. But over the past year, this gap has closed and even reversed. We have female labor force participation above that of men, and also above where it was pre-pandemic. And so good news for the labor market overall, but particularly good news for fields that rely on a more female labor force, especially inside of healthcare, education, some pockets of the service industry. Should be help with recruiting efforts there a little bit as well. Remote work, I think, is one of the safest bets you can make if you're thinking about what changed during the pandemic that is going to be long-lasting. So we're having more of a return to normal, return to office in some regard. But it's a pretty safe bet that remote work is going to be much more prevalent than it was pre-pandemic. And this is something that we can see on our site in a couple different ways. And so we can see the job seeker side of this and get a sense of interest in remote work. This is the share of searches on our site that feature keywords related to remote work. And so what we're talking about here is that what and where box on the Indeed site. When they come to our site, they can type whatever they want into that what box. About 10% of the searches still pertain to remote work on our site. And you can see here that this trend is also back on the rise. It's ebbed and flowed throughout the pandemic, but even 2.5 years into the pandemic, return to office has already come for a lot of folks. We still see interest in remote work rising on our site. So job seekers are as interested in remote work as they've ever been. And there's still plenty of opportunity there as well. So job postings, Again, ebbed and flowed during the pandemic. They've even edged down a bit over the past couple months, but still near an all-time high, and close to 1 in 10 of our job postings on our site feature keywords related to remote work inside of the job posting. If we look at the job categories that have the remote work opportunities, this is the categories with the highest share of their jobs mentioning remote work. It's a lot of the usual suspects. So software development right there at the top, 4 out of 10 of their job postings mention remote work, and also a lot of tech, so IT operations and help desk, information design and documentation, but also some other corporate functions like marketing there as well. So still plenty of opportunity there, and I would say the takeaway here is whatever your employers are offering when it comes to remote work, just make sure they're very upfront about what and clear about what they're offering, and making that known to job seekers, because we know that's still very important to them. So to wrap things up, I know that was a lot of information in a very short period of time, but to wrap things up, I want to give you all some of the Economist perspective on recruiting in the tight labor market, some things to think about. Pay is always going to be important, but it's especially more important when demand for labor is very high and supply is low. When that's the case, pay just typically has to rise, and that's what we've seen. So I think it's still important to think short term. Signing bonuses, retention bonuses, whatever you can enact pretty quickly, and also pull back pretty quickly if the economic environment changes. But also longer term decisions among base pay, benefits, total compensation. Make sure you're competitive there, not only in your own industry, but whatever industry you may be looking to draw workers from. You need to be competitive there as well, as we know how important pay is to job seekers. I would say don't mind the gap or job hopping. With the way the labor market is right now, we still have hopefully many more workers coming back into the labor force, and there's going to be gaps on resumes for many different reasons. And also with the quits rate still as high as it is, job hopping and shorter tenures are going to be on resumes as well. And so I would say, make sure everyone knows to get used to that, because if that's something that you're screening out at some point in the process, that's a lot of talent you could potentially be leaving on the table. And then backgrounds as well. We see an increased instance of second chance or fair chance hiring job searches on our site and inside of job postings as well. That's something employers are being more open about. That's also a function of a tight labor market. You want to increase your talent pool as much as you possibly can. So if there's any allowances that can be made there for what someone has on their record or in their background, that's a great way to increase your talent pool as well. And then remote work, which we've already touched on, but I think it's very important to, if that's an option, make sure you're very upfront, very clear about what that means, and make sure that's in your job postings as well, because we know that's something that employers are looking for. And lastly, I'll remind you about hiringlab.org and also hiringlab.org/data, where you can see our interactive tool, but all of our research lives there on the site. It's again, free resource of information. You can subscribe and get all of our research updates. And if you have international interests as well, we have economists in the United States also, but Canada, France, Germany, the UK, Japan is our newest economist. We're getting him up and running, and then Australia as well. So it's international research available. So I think we still have a bit of time. I'm not going to dance. There's been a lot of jokes about dancing. I'm going to tell you right now. Please have questions, because I can't dance. But if anyone has any questions about anything you saw, anything else that's top of mind when it comes to the labor market and the economy, when you're thinking about your strategy over the next year, but also any perspective as well. You all are much closer to the front lines of this than I am. We obviously, the Economist team, we follow the data, we follow the research, and follow the labor market, but it's always very helpful to hear your perspective as well. So I think we're close to time, but thank you for all your time and your attention. I really appreciate it, especially hearing your perspective as well. So thank you.